Let's say you inherit an IRA from a parent. Most people immediately ask the wrong question, which is how much do I have to take out? The better question is, what rules apply to me and what flexibility do I really have? Because once you understand the rules, the strategy part becomes a lot clearer. And that's exactly what we're going to cover today. So if you have recently inherited an IRA or 401k, we're going to break down everything you need to know and even show you a live case study so that you can plan like a pro. I promise you, you don't want to miss it. Welcome back, guys. If this is your first time here, my name is John Boyd. I'm a certified financial planner, and I'm the founder of MDRN Wealth. If you want help executing planning with your inherited IRA or help building a retirement plan of your own, all you need to do is scan the QR code or click on the link below to get started. All right, guys, so let's dive into it. Inherited IRAs are confusing for one main reason, and that is there isn't one set of rules. The rules you personally follow depend on who you are as a beneficiary, what type of account you inherited, and whether the original owner had started RMDs or not. If you end up missing just one detail, you can end up taking distributions that you didn't need, or worse, miss required distributions that could trigger a 25% penalty. So before we talk strategy or tax planning, we need to get the rule framework right. For the purposes of today's video, we're going to be focusing on the rules for non-spouses. That means you inherited the IRA from someone other than your spouse. If you want the video for spouses, we'll be releasing that one next week. So first things first, I'm assuming you are an individual non-spouse beneficiary, not an estate, not a charity, not a trust. Next question, are you an eligible designated beneficiary? For non-spouses, this is an extremely narrow group. It's either someone that is disabled, someone chronically ill, the decedent's minor child, or someone who is not more than 10 years younger than the person who passed away. If you fall into one of those buckets, you may be able to use life expectancy-based distributions. These are those stretched RMDs that tend to be pretty small. But for the vast majority of adult children inheriting IRAs, you are not an eligible designated beneficiary. And that means you're going to follow the 10-year rule framework. That's where most of our focus is going to be. So before we go further, just some quick clarification. From a timing standpoint, inherited traditional IRAs and inherited Roth IRAs generally follow the same distribution rules. The big difference is taxation. Traditional IRA distributions are taxed as ordinary income. Roth IRA distributions are generally tax-free, assuming the 5-year rule has been met. So the rules we're about to walk through apply to both. The tax impact is what changes. So here's the single most important question in inherited IRA planning, and that is, did the original owner die before or after starting RMDs? This determines whether the 10-year rule is flexible or the 10-year rule comes with annual required distributions. This is where most of the confusion and honestly bad advice comes from. So let's start with the simpler case. If the original owner passed away before the required beginning date, meaning they had not started RMDs yet, and you're a non-spouse, non-eligible beneficiary, which again, most people are going to be considered non-eligible beneficiaries, you're going to be under that 10-year rule. What that means is the account must be fully emptied by December 31st of the 10th year after death. There are no required annual RMDs in years 1 through 9. You can take money out whenever you want or not at all, as long as it's empty by year 10. This is where people hear no RMDs and stop listening. Because while there may be no required distributions early on, there can still be very real tax consequences if you wait too long. And we'll get into that when we get into our case study here in a little bit. But from a pure rules standpoint, no annual RMDs, hard stop at year 10, which means by year 10, everything needs to be emptied out of the account. Now, this is a scenario that caused all the debate, and this is what the IRS finally clarified. If the original owner had already started RMDs and you are a non-spouse, non-eligible beneficiary, you are still under the 10-year rule, but you may also be required to take annual distributions in years 1 through 9. So you now have two rules running at the same exact time. The account must be empty by the end of year 10, and you must continue taking annual RMDs along the way. This is often called the hybrid rule. And this is where I see mistakes happen a lot in real life. People think it's a 10-year rule, so I don't have to take anything out until the end, when in reality, annual RMDs were required the entire time, and they missed them. One detail that's easy to miss: if the original owner was required to take an RMD in the year they died, but hadn't taken it yet, that RMD still has to be accounted for. Someone, usually the beneficiary, needs to make sure that gets done. That distribution is separate from your beneficiary distributions, and it's based on the original owner's RMD calculation. Miss this and penalties are going to apply. Now let's go back to the Roth IRA, because again, this causes a lot of confusion. And honestly, there's a lot of bad information out there on them. Here's the part that everybody knows. Roth IRA owners do not have RMDs during their lifetime. But what trips people up is what happens after the owner dies. Once a Roth IRA is inherited, it becomes a beneficiary IRA, and the beneficiary distribution rules apply. However, and this is a key part of clarification, the IRS treats inherited Roth IRAs differently than traditional IRAs when it comes to annual RMDs. IRS regulation literally says this: after the Roth IRA owner dies, the required minimum distribution rules apply as though the Roth IRA owner died before the required beginning date. So what this means in practice is, for RMD purposes, a Roth IRA owner is always treated as having died before RMD age, even if they passed at 80, 85, 95, whenever. And that treatment carries through to the beneficiary rules. So if you're a non-spouse beneficiary inheriting a Roth IRA, that means that you're going to be subject to the 10-year rule still, but the account needs to be fully distributed by December 31st of the 10th year of death, but there's no annual RMDs that are going to be required years 1 through 9. You can take distributions whenever you want or wait as long as the account is empty by year 10. This is true regardless of the age of the Roth IRA owner at death, because the IRS treats the owner as having died before their required beginning date. So when you hear people say inherited Roth IRAs don't have RMDs, what they really should be saying is inherited Roth IRAs don't have annual RMDs, but they still have to follow that 10-year rule. So before we jump into modeling income and deciding how much to take each year, here's a recap of what we've covered so far. Most non-spouse beneficiaries are under the 10-year rule. Whether annual RMDs apply depends on whether the owner had started RMDs. Roth and traditional IRAs follow similar timing rules. Taxes are what changes. The IRS doesn't care about how you spread distributions, only that you follow the rules and meet the deadlines that they've laid out. So now that we've got the rule book straight, the next step is the part that actually matters in real life. And that is, how do we decide when to take distributions based on income, tax brackets, and what's happening in the rest of the plan? That's what we're going to walk through next using a live case study. So let's dive into it. This is Jerry Rivers. Jerry is 50 years old, single guy, makes $75K a year, wants to retire ideally as soon as possible. He spends about $6K a month. And his father recently passed away. His father was born January 1st, 1946, and sadly his father passed away January 1st, 2026. So he died at 80 years old and was taking RMDs at the time of his passing. So if we look at Jerry's balance sheet, he has some cash in the bank, a 401k of his own, and then $750,000 in an inherited IRA that he just received from his dad. So how do we game plan for this? Well, first and foremost, Jerry is going to fall under the 10-year rule, meaning he needs to have that inherited IRA emptied out in 10 years. But remember, his 10-year clock starts the year after his father passes away. So the year we inherit an IRA, we're always going to view that year as year zero. And you potentially don't have to take anything out in year zero. So again, this is year 2026, so that's year zero. Then we get to year one, that's 2027, 2028, 2029, 2030, 2031, 2032, 2033, 2034, 2035, and then 2036, right? So that first year is year zero. So in year zero, which is 2026, the first question we need to ask ourselves is, did dad have an RMD? And question number two is, did dad take out that RMD? So in our case here, dad died at 80 years old on January 1st, 2026. So we know for a fact he did have an RMD. The next question we need to ask ourselves is, did he take out that RMD? And in this case, he did not. Now, because dad didn't take out his RMD before he passed, Jerry is now responsible for taking out that RMD. And because Jerry is responsible for this, it's going to show up on Jerry's tax return. If his dad had hypothetically taken out that RMD before he died, it would have showed up on dad's final tax return. But because he did not, Jerry needs to take it out. So if we assume that on 12/31 of last year, Jerry's father IRA was worth $750,000, his RMD would have been worth $37,128.71 in 2026. And because his father did not take it out, Jerry is going to be on the hook for that amount. Now, let's go ahead and fast forward to next year, 2027. Which is going to be that first year of that 10-year clock to fully distribute. The first thing we need to ask ourselves before we start calculating how much we need to take is we need to figure out what our RMD for 2027 is. Remember, because Jerry's father was taking out RMDs, we need to also take out RMDs in 2027. So you can't just say, I'm going to make this amount and I want to skip taking anything this year, right? You can't do that here. In this case, because Jerry had an RMD, he needs to take at least that out. The big difference in year one is that RMD is now going to be calculated using Jerry's life expectancy instead of his father's. And because Jerry is only 50 years old, his longer life expectancy is going to result in a smaller required minimum distribution. So based on our estimate, it's going to be around $20,000. So here is our first major challenge we need to solve for. Do we take the minimum amount in 2027 or do we go with a higher amount? From experience, most people who are subject to the 10-year rule simply take the balance and divide it by 10. So going into 2027, let's assume we invested that inherited IRA so it grew a little, and we, of course, had to take out that $37K. Let's assume the value of it going into 2027 is going to be $740,000. That means if we just divide it by 10, it would be $74K a year that we need to take out. So let's go ahead and look at all of this modeled out from a tax projection standpoint. If we take a look here, you're going to see two different scenarios. The scenario on the left is where we take the minimum, right? That minimum 20K that we know we have to take out if we want to be all good with the IRS. Scenario 2 is where we do that even split. So remember, Jerry's working here. His gross income, we said is $75,000. He, contributes to his 401k, pays for health insurance, so his taxable wages will be a smidge lower. For the sake of simplicity here, the only other income that we're going to model in are those inherited IRA distributions. Again, one scenario is at $20,000, the other is at $74,000. What I want to show you is that if we just blindly, again, divide it by 10, which is what I see most people do, take a look at the difference in taxation here. What you can see is you're going to have $12,000, roughly $12,000 in additional federal taxes that are paid. And then you're also going to have an additional $5,000 in state. Jerry lives in California, so very high tax jurisdiction. So again, we're looking all in a little over $17,000 in additional tax that Jerry has to pay as a result of this. So again, not super optimal scenario. So this is where planning is really, really important, and why modeling out your income over a multi-year, 10-year span is really important. Because if we did a little planning here, maybe Jerry actually wants to retire in the next 5 years. So if that's the case, maybe for 2027, we stick with the minimum amount, right? So we say, hey, let's just do the bare minimum that we have to take out, which is 20K. And then when you retire in, let's say, 5 years, then we'll go ahead and take larger amounts because you're not going to have any wages come in. And then by year 10, of course, make sure that it's all emptied out in a tax efficient way, right? That is one way that we could go about that. Or we could, let's say that Jerry had a large tax deduction in the next couple of years that we were aware of, or was going to have a gap year of some kind, right? Same logic. We can plan around those income gaps. The other scenario, again, I talked about dividing it in 10 and some of the risks involved with that. But what if we were somebody that said, I just want to take the minimum amount out. I don't want to have to deal with taking any more than I have to. I just want to take the minimum out, and then in year 10, I'll deal with it. Well, if you do that, let me show you this scenario. This is tax year 2026. Let's move that back. Let's take a look at tax year 2036. Okay, so let me pull this up. Again, I know that it says 2034. That's as far as we can go out in this particular software. So just for the sake of argument here, just assume it's 2036. So if we assume it's 2036, let's assume that Jerry's still working at that time. His income has gone up a little bit. Taxable wages is now $84,000. But then take a look at how big this inherited IRA distribution is going to be. Remember, he inherited about $740,000, right? $740,000 or $750,000 or so was his inherited IRA that he received. And if he's just taking out the minimum, right, that might only be maybe 3%, 3.5% of the overall value of the IRA. And if he's investing it, let's say in even a moderate portfolio, maybe it grows at a 6% clip per year. So he's netting a little bit of growth every single year during that 10-year span. And before you know it, he has this massive inherited IRA that he has to deal with in year 10. And what happens in year 10? He has to empty it. He has to take it all out. And you can see that if it's worth $1 million at that time, he's literally setting himself up to have a tax bomb go off in his lap. $342,000 is projected tax liability on the federal level, $110,000 on the state. So again, this is a real risk that a lot of folks are dealing with, because I see them just neglecting wanting to take any out and wanting to slow roll it as long as possible. So again, this is assuming that Jerry's dad had a RMD that he was dealing with, and that Jerry's going to have to take out at least a minimum. If Jerry's father did not have an RMD, the logic doesn't really change a whole lot here. The only difference is that Jerry no longer has to have a minimum. He can have certain years where he can opt to take zero, and then other years where he takes a lot out. So in this case here, if Jerry was going to retire in 5 years, maybe we say, hey, Jerry doesn't take anything out of his IRA for the first 5 years, and then we'll deal with distributions in the final 5. That's another way you go about it. If this was a Roth IRA, a little bit more straightforward, right? With the Roth IRA, grow it as much as possible. Try to not take anything out so that it keeps growing tax-free. And then in year 10, take it all out when you have to. Just continue to maximize the use of that Roth. So I can't emphasize this enough. How you take distributions from an inherited IRA should be driven by an income plan over the next 10 years, not just by the rules. If you can identify periods where your income is lower, maybe between jobs, before Social Security, or an early retirement, those are often the years you want to take advantage of. And at the same time, you want to be careful about simply taking the minimum every year, like you saw in our example, because that can secretly or very sneakily create a tax bomb that you'll have to deal with later. You also want to be cautious about just simply dividing that IRA. Again, we saw some of the risks involved with that, because equal withdrawals, just dividing it in 10 every single year, may not align with your income goals, tax brackets, or what's optimal for you. Final note, when it comes to investing in an inherited IRA, it's important to revisit what's inside the account. When you inherit an IRA, you also inherit the existing investments. And because the original owner is often older, the portfolio is frequently very conservative. I'm not saying you should dump everything and put it all into stocks, but the inherited IRA should be invested based off your income needs, your time horizon, and your personal goals, not the decedent's. That might mean using an allocation that balances growth while also reducing sequence of return risk so that you can take required distributions without being forced to sell at a loss if markets are down. And that's really the point. The rules tell you what you must do, but planning determines how well the inheritance actually works for you. If you inherited an IRA or received an inheritance and need help planning and doing the planning like you saw today, then click on the link below or scan on the QR code to get a free retirement assessment with our team. I hope you enjoyed today's video, and I will see you next time.